Great. Thanks to Avner and Jim for inviting me here and allowing me to discuss this very nice paper. Let me get into the basic idea, which was explained. Gregory explained it very well. Why are we looking at adverse selection in loan markets? And there are at least two reasons, maybe more. Borrowers know more about their types than lenders. And of course, some lenders know more about some borrowers than other lenders, okay? And what the authors focus on is that competition in loan markets can change the degree of adverse selection. Think about a loan market in which there's only one bank. Basically, that bank knows who has been screened and rejected and doesn't bother interacting with them again. If you have more competition, you could have more adverse selection. There are a whole bunch of people who have been screened and rejected, but you don't know who they are. And that leaves a trail of adversely selected sample of applicants. And that means there's potentially also market power for lenders who know borrower types, either because they're better at screening or because they have interacted with a borrower before. And this should be particularly strong in borrowers who are observationally low types. That is, everybody else thinks they're not very good, while you think as a bank, having screened them or having interacted with them before, that they are very good. And I want to emphasize this because there's a way of testing the details of the idea a little more. So, the authors have a fantastic data set, and they get the probability of default and loss given default as assessed by the bank, and they obviously exploit this. One question, of course, is this truly private information? How much of it is correlated with other things that other banks know? We do see the interest rate, but is there more than the interest rate? I'll come back to that a little later. But what they find, and this is an important finding, is loan non-performance or realized default is uncorrelated with the interest rate after including these measures. In other words, basically they carry more information. One of the questions, we'll come back to this, what is this private information again? So the results, which were very clearly described by Gregory, are interest rates, borrower default risk, loan volumes, are all higher in areas with more lender banks. And this itself is very surprising. It's not something necessarily that we would expect. More competition should drive down interest rates. And what they find is interest rates are higher in areas with more lender banks, even after correcting for this element of bank private information, suggesting, in their view, some market power. And I'll come back to this also. I think the most interesting test is that firms that stay with prior banks pay a higher rate, but this is attenuated if they borrow from multiple banks, arguing sort of that other inside banks have information, and this reduces the market power of the inside bank that lends. There's competition between insider banks. Okay, so that's what the paper does. Let me talk a little bit about a broad assessment and then get into details. Clearly, it's a very detailed, interesting data set, and an enormous amount of work has gone into it, and very intriguing results. I should confess I'm not a disinterested party here. I'd love the results to hold. But I have a duty as a discussant. So let me talk about the main questions I have. Where does bank private information come from? I think the information coming from past lending is certainly plausible, but the authors also want to talk about banks being better at screening. I think more tests that focus on this would be useful. Can you identify banks that are better at screening? Can you look at the data and see from realized defaults, these guys are really better in their assessments? And can you use that then to indicate these are the guys who have market power? It seems like you have enough data to do that kind of test. And of course, it'll be interesting to know how banks get this advantage. Which are the banks that are better at accurate screening, which are the banks that are worse, and what kinds of markets do they operate on. There's an enormous amount of detail you can add to what you've done, and I think that would be very interesting. The second issue is selection biases. You don't talk very much about this. I'll talk a little bit about it. And there are a lot of selection biases running through the paper, and that's something at least a little bit of attention would be useful. And that relates to the theory itself. I mean, there are a lot of theories of adverse selection now, and some of them have implications that would sort of offset what you're testing for. We'll talk a little bit about that. And finally, come to alternative explanations, one of which you alluded to, and I think more on that would also be useful. So let's talk about selection biases. The first obvious question is, what determines the number of banks in an area, right? What determines concentration? Where does that come from? Could it be that there's more demand for loans here? Could it be that there's a greater branch network and a stronger deposit base? Could it be there's a greater degree or there's lower degree of natural information asymmetry here? I mean, it's worth talking about it. I'm not sure you can do a lot about it, but certainly you can talk about it. And then there, in the literature, people have looked at ways of dealing with this. For example, looked at large bank mergers. That would change the number of banks in a particular area, because that would change the effective number of banks. And that's something that you showed is happening during your data set. That may be an exogenous way of changing the number of banks, and you might want to exploit that to show that this sort of selection is not driving results. A second is, how is the potential population of applicants determined? The population of applicants is endogenous. That's what a number of theories, Yunze here has written a paper on this. Firm entry is driven by the degree of adverse selection already in the markets and what banks actually do. And so that also changes the pool. Remember, one of the reasons that adverse selection is guys have been tested before and rejected. Well, what if there are a whole bunch of fresh applicants who enter the pool? That reduces the degree of adverse selection. That should change the environment. So looking at that would be, looking at some of these theories, I'll talk about another one in just a second, would be useful. The third point is, what determines who gets a loan out of those who apply? Remember, what we're looking at is a selected sample out of the applicants. We're just getting the loans. So since we're seeing only the loans that are granted, certainly a lot more attention to the distribution of these loans in these different areas would be useful. Who's getting it? How many are getting it? That would be interesting. And it'd be nice to know if that's skewed in certain areas relative to others. I think much more focus on the distribution would be useful to give us a sense that if the underlying sample is similar, and obviously there are questions about that, but even if the underlying sample is similar, what is the skew in these more comparative areas? And of course, within those applications, how are the loans in the sample that the authors look at selected? And there's a little bit of that I think the authors need to explain a little more, that doesn't have effects. For example, we already saw they dropped a bunch of loans because they didn't want to focus on large borrowers. But there are other forms of selection that take place. Loans that are not utilized within 2 quarters after initiation are dropped. These presumably are lines of credit that are not drawn. But then lines of credit that are not drawn are typically lines of credit to higher quality borrowers. What influence does that have? And that's something to think about. Again, I don't think these undermine the basic result, but it'd be nice to do a lot more to show that this is not important. And then finally, what is the theory? I think the authors broadly talk about adverse selection theories, but it makes sense to go to the details, because detailed theories have different implications. For example, in Della Riccia and Marquez, 2006 in the JF, when you have many banks, the same adverse selection issue applies. But then you have this endogenous arrival of firms, and more fresh unscreened firms lowers the degree of adverse selection in the pool. And what that means is, at that point, the banks shift to offering unscreened loans. So, in fact, they don't do any screening in that paper. When there's a high degree of adverse selection, banks actually shift to secured loans. So that's something that is testable. Is there a shift in these different markets to different types of loans? And does that say something about the kind of model that we have? Other theories, Yunz's theory has different implications. So I would say pick a theory and go look at the more detailed implications, and that would, again, be very useful in convincing us that these are interesting, important effects. I also would urge the authors to look at the more detailed implications of adverse selection theories. I already talked about the distribution. I think it would be interesting to look at the situations. Now, you run regressions, but look at the loans which have a big distance between the market interest rate and the inside information that you think the banks have, and ask whether that's where you have the highest profitability, as you can measure, because you also measure the realized default rate within 1 year. So is that where you have a significant profitability? That's worth looking at, because you're looking at the more detailed implications of the adverse selection model. Marquez and De La Riccia talk about the higher use of secured debt. You would think that that would be an answer to adverse selection. Do you see, again, this is talking about the distribution, do you see more secured loans in these greater adverse selected markets? And lastly, you test how banks get good private information. Is it true that they get more good private information when they have a relationship in the past? That's what you test. But is the degree of market power in these relationships highest when public information differs from private information? So in a sense, I'm asking for an interaction between the difference between the private information and public information and the fact that you've stayed with your lender. Can you see that that's where you have market power the most? Lastly, let me offer an alternative theory, which you hinted at. Supposing banks are generally conservative, make positive NPV loans, and focus on preserving franchise value. This is an old theory in banking. And supposing competition forces them to take more risk, okay? And one of the interesting factoids, Drexler, Savov, and Schnabel argue that deposit rates are often raised more quickly in competitive areas when the Fed tightens, right? So this has implications for the flow of deposits, because if you raise more interest rates more in certain areas than in others, you would see deposits flowing from the concentrated areas which don't raise deposit rates to the competitive areas, from the flighty depositors, the guys who don't necessarily need to stay with their banks. Well, what happens in those areas is that the competitive areas getting a lot of deposit inflows start lending them out, and they exhaust the safe local loans, and now they search for yield, essentially money burning a hole in their pockets. I say this because we have a paper which looks at this, and it shows that in the areas with higher competition, you actually have higher risk loans being made, higher spreads, and lower profitability rather than high profitability. And this is deriving from just the competitive instinct, because this is a time series effect which happened when the Fed raised interest rates the last time. It's too complicated to explain this model. What this is basically saying is when you look at realized default rates, you find the realized default rates are much higher in the competitive areas during the time that the Fed was tightening interest rate policy, because they had a big flow of deposits into the competitive areas and they lent them out crazily. Now this is not the period covered by the data set that the authors have, but this is hinting at the fact that there is another theory which is also possibly at work. More competition stretches you towards the limits of credit quality, And that may be partly driving it. Now, that's why I'm saying your tests on the specific market power, one of which you already present, which I thought was the most interesting test that you do, if you do more of those, it will solidify your paper as this is an additional result building on the broader result of franchise value, which people have hinted at. So let me conclude. Fantastic data, very intriguing results, and my basic suggestion is do a little more, as all discussants say. Be specific about the theory and implications, and test the detailed implications, but I think this has great promise. Thank you.